Right. Let's dive straight into this explainer because today we're unpacking one of the most head-spinning business collapses in modern startup history. Seriously, just a few years ago, WeWork looked completely unstoppable. I mean, they weren't just a company. They were celebrated globally as the definitive future of work. They literally promised to elevate the world's consciousness just by changing how we interacted in the office. But how did a company with that much momentum, one that completely captivated Wall Street and Silicon Valley alike, become the ultimate symbol of strategic overexpansion? We're going to break down this complex story step by step to understand exactly what went wrong.
At its peak, the sheer scale of WeWork's operation defied all logic. They weren't just growing, they were exploding across major global cities, snatching up premium real estate, dominating the media cycle, and raising billions upon billions of dollars. And their valuation? It peaked at a staggering $47 billion. That is a number normally strictly reserved for deeply established tech giants. The perception was absolute. WeWork was conquering the corporate world, reinventing real estate, and literally no one wanted to miss out on the revolution.
But there was this massive elephant in the room, acting like a ticking time bomb right at the foundation of the company. What happens when a grand vision has zero sustainable profit? We're going to explore how that aggressive expansion, mixed with a highly dangerous disconnect from actual financial reality, set the stage for total failure. The gap between how the world perceived WeWork and the bleeding reality of their balance sheets eventually became impossible to ignore.
Part 1. The Vision Seduced Investors.
To really grasp the hubris here, you have to look at the narrative WeWork was selling, because that story was the fuel for everything. It was so much bigger than just renting out desks to freelancers. They brilliantly positioned themselves as a technology-driven community platform. They outright refused to say they were a real estate company. Instead, they were selling global workspace transformation. By tapping into modern entrepreneur culture, offering kombucha on tap, neon signs, and this deep sense of belonging, they made traditional corporate landlords look like total dinosaurs. It was magnetic, and it sparked this unprecedented, almost euphoric investor enthusiasm.
By wrapping themselves completely in tech buzzwords, WeWork pulled off an incredible illusion. They basically convinced the market to value them based on the infinite scalability of a software company. And here's why that matters. In the investing world, a software company gets a massive valuation multiplier because once you build the code, adding 1 million new users costs almost nothing. Real estate? It absolutely doesn't work that way. But investors were paying these massive premiums for technological disruption, kind of ignoring the fact that they were really just paying for fancy office space.
Section 2. The Dangerous Expansion Addiction.
So their strategy was built on a classic, high-octane startup mentality: grow first, figure out how to make money later. They took those billions from high-profile backers and used it as a war chest to aggressively sign commercial leases at top-of-market prices. Within a couple of years, they were launching in global cities at a dizzying pace, literally opening new buildings almost every single day. The goal was pure scale and brand dominance. They figured if their network was everywhere, they'd essentially become a physical monopoly for office space, and the profits would just magically follow.
But beneath all that explosive growth, a deeply dangerous mismatch was brewing. Think about the money coming in. It was short-term, flexible revenue from folks who could cancel their desk rentals by the month. Now contrast that with the money going out. WeWork was signing massive, unyielding, long-term leases with building owners, often locking themselves in for 10 to 15 years. So they were paying for decades of expensive real estate liabilities using monthly cash flow that could literally vanish in weeks if the economy took a hit.
Part 3. Real estate disguised as tech.
I mean, ask yourself, would you value a traditional commercial landlord the same way you value a tech company? Of course not. A true scalable tech platform has almost zero marginal cost to expand. But traditional real estate, which is what WeWork actually was, is anchored in physical reality. Buildings need heavy upkeep, constant staffing, massive renovations, and they carry huge risk if a recession hits. You can't just write some code and spawn a new office building. WeWork was playing a game of concrete and steel, but they were keeping score like they were selling ones and zeros.
And this relentless drive was heavily championed by their charismatic founder, Adam Neumann. His leadership style demanded speed above all else, but that singular obsession introduced massive governance risk. The company basically became addicted to expansion. To keep up the narrative for that soaring valuation, internal controls and basic financial accountability were just shoved aside. There was erratic decision-making, highly questionable personal financial transactions, and frankly, there just wasn't anyone in the boardroom willing to step up and hit the brakes.
Behind the scenes, the financial losses were expanding just as fast as their footprint. But for a long time, the bleeding was hidden by flashy ribbon-cutting ceremonies and breathless media hype. Eventually, though, an incredibly awkward question had to be answered. They were burning through billions of dollars in cash just to keep the lights on. What exactly happens when that generous investor money finally runs out?
Section 4. The IPO Reality Check.
So private investors had supported the company based purely on vision and FOMO, the fear of missing out. But public market investors, they are a completely different breed. They demand to see the actual math. When WeWork filed their S-1 paperwork to go public and legally had to open its books, the illusion shattered in real time. The massive multi-billion-dollar losses were laid completely bare. Public scrutiny magnified all those governance concerns we talked about, confidence evaporated overnight, and that perceived $47 billion valuation plummeted. In a deeply humiliating defeat, the IPO had to be abruptly canceled just to save the company from outright bankruptcy.
The wildest part here is how incredibly fast a market narrative can flip. Literally one moment, they're a world-conquering unicorn redefining humanity's relationship with work. The very next moment, the emperor has no clothes. Suddenly, they were viewed as a fragile house of cards built on deep operational weaknesses. It really proves that while growth stories and magnetic founders can sustain momentum temporarily, operational reality always wins in the end.
Part 5. Lessons from the collapse.
So, what are the big takeaways for us here? First off, expansion alone doesn't guarantee success. Scaling a weak, asset-heavy business model just amplifies its hidden flaws until they break the company. Second, business fundamentals, like actual positive cash flow, will eventually override Silicon Valley hype. Third, governance is never more critical than during hypergrowth. Someone has to be the adult in the room. Fourth, never confuse a physical asset business with a digital one. The risks are fundamentally different. And finally, boundless ambition is awesome for a startup, but it absolutely must be balanced with strict financial discipline.
Which leaves us with a pretty sobering thought to wrap up this explainer. In today's frantic quest for the next big disruption, how many other visionary, multi-billion-dollar companies are operating right now, celebrated by the media, adored by venture capitalists, yet are just one public reality check away from total failure? Thanks for joining me today, and hopefully this gives you a much sharper lens to view the next big startup success story.